Hello traders, welcome to FreeFX. My name is Francesco and we have quite a lot of information today from the week that's just been by. It's a week that broke the markets. We've had absolutely nothing from the likes of S&P 500, Nasdaq and Russell 2000. It's really been a struggle for these indices. If you look at the blue line here, the close line for the S&P 500 back in February, and where we are now, we actually below that, so we're into the 3300s, pretty much under the 34, which is quite a strong level. That's the 34 there, just over these two humps, and we're just below that. So what we're looking for is an overbought, heavily overbought stock market scenario and kind of context. Now everybody's supposed to beat the market, which is kind of common parlance for the stock market, which is common parlance for some of these indices which kind of gather all the major stocks together in a basket. And I would certainly be doubtful that these trends stop with ease. It takes a lot of struggle and resistance for people to come out of a lot of money invested in a certain direction. As a private trader, I do find it ludicrous that we are stuck to the idea that the only way to invest seriously is the stock market, having seen what what kind of value stock markets to a private trader can add, which is very little. Yes, you could say, well, had you held for a year, your returns would be incredible, but really, I don't buy it, because then you get something like March, and look at the collapse in this. We go to some lengths to buy and hold and tell everybody that is the way to invest. Actually, private traders can be much more agile than that, and there's nothing wrong investing in the stock market, but to just put in a portfolio management style buy and hold and diversifying risk that way is really not the way to go for private traders. Private traders in currencies, for example, who don't have to go to great lengths to buy or sell. There's no kind of extra costs for selling or additional kind of concerns. Really, it's quite, or contracts of difference generally are the way to go. And also, everybody's on the stock market. Everybody, if you go to a financial advisor, they would probably advise to buy into a fund, invest into a sort of basket of shares in various companies. If you go to your bank and do some investment strategy with them, all very fine if you don't have the time and it frankly is not something that you're interested in. You just want to park your money somewhere and let somebody take care of it. But if you go to innovative funds who use quant trading, if you use your own trading, etc., you can beat the stock market, and consistently. That's the key, is whether you can do it consistently, which you can. If the returns are 8%, 10%, whatever, on average 8%, you can beat that, and absolutely it's not an insult to people who work in financial services who would say that is wrong, because they're simply different ways of approaching this market. If I look at this as a private trader and see that everybody's sort of stuck to this dead end kind of stock market offer, I would frankly not understand the problem with coming out of it and using other means of investing. And trading is part of an investment strategy, because somebody has to put those transactions on, plan it, whether they use machine learning or whether they use human discretionary trading. At the end of the day, it's a transaction that's made with the best kind of probability behind it. So, having said that, what returns can this overbought stock market bring us? If we'd done this analysis back here in October 2018, you could have said, well, we had a correction there, we came back to it, and then it kind of continued higher. So actually you're wrong. The stock market always climbs, and there are very few crashes. 1987, 2008, 2009, etc., etc. So it doesn't happen every year. Bull markets continue to grow for years. Absolutely true. But do you want to be stuck waiting for a bank or somebody to invest your money, or parking shares and hope for the best with no idea, or actually actively trade it? If you actively trade and keep your losses small and maximize on your profits, even if you're 60% wrong on your calls, it's the 40% that make the money. that count. So it's not about getting it right. It's not about finding the perfect system as a private trader and always thinking you're inadequate because you haven't got an MBA. It's really just about having the common sense of protecting capital, taking action when market conditions change. So for example, in my last few weeks in September, I've lost on my account something in the region of 20% of my account, and that's been just, it's what happens in a stalling market where currencies like Euro USD and US dollars, you can see here, a real stall. We have an inverse head and shoulders forming here, and we're kind of battling with this level at 95, which is a kind of long-term midpoint of a larger kind of wave cycle. And you have all these things that are stalling kind of risk trend, which doesn't help some currencies as well. I'm kind of struggling with that because obviously there's a correlation between them. And I try to kind of trade my way aggressively through some of these moves, like in the US dollar here in early September. And then there was a bit of chop here, and that's kind of where I made some losses between that and Euro USD as well. Also tried to trade the S&P day trading, and it has actually brought me a bit of money. Overall, I'd say the cheapest one of them all between S&P, US dollar index, and gold and Euro USD is Euro USD. So I always kind of try to get in on that before these. But certainly the Euro USD is an embattled currency, and it does pay to think that the Euro US dollar is a tricky buy at the moment, whereas we've got that 119 roof, whereas the US dollar index has a lot of room to the upside. Certainly, even if you got from here to 95, that's a good buy up to this point, and actually a very good sell from there. So I'm not sort of like a stock trader with bull markets. I'm just talking about short-term, a few weeks and reverse. That's not really of interest to me to be a bull or a bear. That basically is the sum of this week of stalling stock market that goes nowhere in weeks and weeks. Lots of content coverage about why there's nothing happening in September after the summer kind of break in August. There should have been a return to normal trading activity in September, and that's not been the case, obviously, as you can see from risk trends, and also the US dollar is not really giving us much at the moment, and the Euro USD is similar. I'd just like to say, trade for yourselves. Do not listen to news commentators and media going on about bull markets, bear markets, buy, sell. It's nothing to do with currencies. It's nothing to do with trading or day trading or intraday trading or keeping your positions for 2-3 days or whatever. Be serious about the markets. Do not listen to people who tell you that you're not qualified to understand the markets because you've not attended a business school or because you're not employed by an investment bank. The tools that you have are sufficient if you apply some kind of way to stop yourself burning out. Burning out means burning your capital within a few trades. Think of your risk of ruin, as I call it. So if you kind of burn 10% on a trade, 10 trades will burn your entire account. And obviously, every time you chop your equity down, you have less buying power or selling power. So that means you can really do very small bits of your positions will get smaller and smaller. So my 20% loss in September is, is significant, but my account is strong enough to still have lots of buying and selling power. So actually it doesn't, it bothers me, but it doesn't bother me because I know that I'll make that money back when volatility returns. So at the end of the day, trying to understand these changing situations, and I want to call them markets because currencies are not the markets like the stock market. They're a very particular kind of trading. And yes, I can sort of try to dip in and out of things, but at the end of the day, I'm a currency trader. I buy and sell and try to stay agile with my head, but again, not getting fixated with projections one way or the other. So it's trying to look at correlated assets and look at which one is the best buy, the best sell, even if they're going inversely in the same way, in opposite directions. But maybe one has more room to go, like the US dollar has more room to go up at the moment than the Euro US dollar has room to go up. And obviously they're inversely related, but they can behave differently from time to time. And also selling your US dollar at 1850 is not as attractive as selling at 120, for example. So if it gets to 119 and the US dollar is kind of breaking that head and shoulders down, and we're heading for further losses, then it's a good time to buy up the US dollar, etc., etc. So think correlations, what are the best buy and take levels, and also educate yourself, and educate yourselves. With that, this is the week that broke the markets. There's definitely nothing happening of interest. Makes it very difficult to extract profits from a dead market like this. If your watch list, spans far out, you might be able to find opportunities in lots of places. Depends on your style of trading. For my style of trading, this week has been very poor, and weeks before as well. A bit of movement this week with the FOMC rate decision, but even that's not really been a market mover. But the fact that the stock market, S&P 500, is giving us that trigger, that signal that something's not quite right. If a sell panic begins, even if it lasts 3 days, I think we'll see something like US dollar gaining traction. Then it's a really great buy for me personally, because I think that is the way to go. Gold has been struggling as well, so I watch gold and US dollar and see which one is moving first. If it's the gold trade that takes hold and the dollar is not really moving, obviously gold is quoted, the quote currency is the US dollar, so I had to watch both of them really to see what happens, and one will give us a clue about the other. So keep your eyes out. This week coming is going to be absolutely fantastic. There will be opportunities, I think, because there has to be a resolution to this in one way or the other. But it's knowing when it's a real resolution and it's not a false signal. That's the main thing. So having the patience, and when you lose, as I've done, you lose a bit of patience. That's where you make mistakes, because you start reading too much into moves that haven't been confirmed. So acting too early sometimes gives you the maximum kind of profit range. Sometimes you can get stopped out too soon because it's a false move. So keep your eye on the markets this week. It's definitely going to be an interesting one. Also, if you're trading the leader, Euro TRY is looking great. There's the Turkish rate decision coming up, and it's a very risk kind of trade, because risk off would take that down quite considerably. It's like more than 10 years of it trending, and it's only had a correction in 2018. That's been the only one, a serious correction that we've seen for some time. So it's definitely due some kind of correction. The RSI is all over the place, diverging. So the Turkish lira play with the euro is a great one, but it's a bit expensive, so it's not for everybody. If you've got a small account, it won't really buy you much per pip. I'm away. I'm going to enjoy the rest of my weekend. Just wanted to really touch base. Again, thank you for watching my videos. Having 68 subscribers may not be much to other people, but it's actually fantastic for me. I know that you're watching, and I'd like to thank you. And please ask me questions about any of these topics. If you want to know more about how I trade live, etc., that's another thing I'd like to cover sometime. So take care, keep safe, and I'll see you in my next video.